Welcome to Tesla Deep Dives. We are committed to objective, in-depth insight. The pivotal topic on our agenda today is the scalability question. Tesla's Robotaxi expansion in Austin and Arizona. Is the autonomous revenue wave finally here? Tesla's valuation has long been driven by a promise, the Robotaxi network. The recent expansion in Austin, Texas, and the securing of a permit in Arizona mark the transition from perpetual promise to initial deployment, forcing the market to ask, is the autonomous revenue wave finally here, or is this just another hype cycle masking core EV challenges? The answer will determine if Tesla remains an automotive giant or explodes into a $2 trillion AI and mobility behemoth. This is the critical inflection point that CEO Elon Musk has repeatedly highlighted. On a recent earnings call, Musk stated that robotaxis would begin to move the financial needle in a significant way, implying billions in new revenue by the middle to second half of 2026. This bold prediction underpins the bullish narrative that autonomous ride-hailing will be the company's ultimate margin driver. The launch reality is currently more modest than the rhetoric. Tesla initiated its ride-hailing service in Austin in June 2025 and the Bay Area shortly after, with all current operations requiring a safety driver. The Austin fleet, which has driven over 250,000 miles without a driver behind the wheel in testing, is estimated to be around 30 vehicles and is slated to roughly double to approximately 60 in December 2025. This planned doubling is a positive sign, yet it still falls far short of Musk's earlier public target of 500 operational robotaxis in Austin by year-end 2025. The scalability question hinges on Tesla's unique camera-only full self-driving (FSD) system, recently updated to version 14.1.3, which relies on a generalized vision-based AI. This vision-only approach offers inherent scalability, as it leverages the existing fleet of millions of vehicles and avoids the substantial per-car cost of LiDAR and radar used by competitors like Waymo. However, critics cite reports suggesting camera-only systems suffer a significant drop in performance, sometimes up to a 40% rise in miss rates under poor weather conditions like fog and snow. The bullish narrative remains potent and currently dominates market sentiment. Wedbush analyst Dan Ives, a notable Tesla super bull, recently raised his price target to $600, arguing that the true value is anchored in the accelerated AI and robotaxi development, not just EV deliveries. This perspective views the company not as a car manufacturer, but as a future AI utility, evidenced by the high projected forward PE ratio of 147.53x for 2025. Furthermore, Musk's massive pay package is tied to achieving milestones, including deploying 1 million robotaxis, reinforcing the strategic centrality of this goal. Skeptics point to execution challenges and a stiff competitive landscape. Competitor Waymo already operates a fleet of at least 400 autonomous vehicles in Phoenix, Arizona, and has completed over 10 million fully driverless trips, giving it a substantial lead in operating experience. Moreover, crowdsourced data from the initial Austin test fleet has indicated a high rate of manual interventions, suggesting an estimated failure rate of between 1.28 to 5 incidents per day for a 10-car fleet, nearly 10 times higher than Waymo's publicly disclosed disengagement figures for Phoenix. Adding to this, some internal analyses, reportedly shut down by Musk, suggested the original robotaxi plan would be a money-losing venture, raising concerns about the near-term economic viability. Financially, the market is in wait-and-see mode. Consensus estimates show a near-flat revenue growth outlook of just plus 0.37% for 2025, reflecting the pressure from price cuts and tariff impacts, such as the $400 million hit in Q3 2025. The short-term pain is attributed to high capital expenditures on AI and manufacturing. The company itself has cautioned that the meaningful financial contribution from robotaxi services will likely only become visible in the back half of 2026 and scale meaningfully in 2027, pushing the revenue wave further out. Despite mixed Q3 earnings and a cautious 2025 revenue outlook, the stock has surged by approximately 28% over the last 3 months, showing that the speculative AI as a service narrative currently dominates. Investors are willing to overlook short-term margin pressure for the long-term potential of the Cybercab and the FSD network, which is viewed as a high-margin software business that will unlock unprecedented asset utilization rates for vehicle owners. Investors must monitor 3 critical metrics to gauge true scalability. 1. The Cybercab dedicated robotaxi vehicle, slated to begin mass production in Q2 2026. 2. The exponential increase in the current Austin/Arizona fleet size. If Tesla fails to hit a 6-figure fleet count by late 2026, the scaling narrative will be in jeopardy. 3. Publicly reported disengagement statistics from the uncyber testing, which will be the ultimate barometer of safety and technological maturity against competitors. Let me know what's your thoughts and leave your comments. Thank you for joining us for this crucial deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.